We're moments away from the start of your cash trading day. It is Bloomberg Open Interest. I'm Manish Cranny. Let's just show you how these equity markets are at the moment. Stoic with, a fairly robust jobs report. Wages are up. Unemployment is down. Yes, the headline number missed ever so slightly. But the S&P 500 is flat going into this. The Nasdaq, we'll pick up the story on Amazon in just a moment. It's about the flow. $600 million left the U.S. equity markets through to the 5th of February, according to Bank of America's flow show. There you go. Good ringing the bell at the Nasdaq. We're just waiting for these equity cash markets to open. So it is about the flow in terms of that excellence of the US, that uniqueness of the US relative to the rest of the world. And this is what Bank of America say. Global dominance may be challenged. Cash market is open, 60.84, 21.780. We'll talk through the tech narrative in just a moment. There are some individual names that we're going to keep a close eye on through the day. Affirm shares, up 11.3%, surging after swinging to a profit in the last quarter and giving a nice strong outlook for the full year sales growth. A number of analysts are actually raising the price targets on the company following the earnings call. Vonnie.
Well, Manus, we have a different story when it comes to e.l.f. Beauty, the low-price cosmetics giant, seeing a slowdown in demand for January, and that prompted it to soften its outlook. But that could spell trouble for the full-year growth for 2026, or at least expectations for that. We'll be talking to the CFO in just a little bit. So that's e.l.f. down 26%, losing a quarter of its market cap already today. Skechers also issued annual forecasts for sales and profit that trailed Wall Street expectations. Pinterest, though, well, there's a better story there. It posted strong holiday quarter revenue and gave an upbeat forecast for sales in the current period. Now, Amazon, well, we know it warned investors it's struggling to keep up with capacity for AI demand. And this in spite of plans to invest $100 billion into data centers and homegrown chips and more this year. CEO Andy Jassy says growth will be lumpy as he deals with constraints in hardware and electricity. The stock right now down 2.6%. But let's take a closer look at these Amazon results with Bloomberg Technology co-host Carolyn Hyde. So for Amazon, Carolyn, what is the biggest concern? Is it access to NVIDIA chips, developing its homegrown chips, capacity?
Power, chips. This is what Andy Jassy said, as thus far perhaps curtailed them meeting the extraordinary demand that we're seeing for their compute. This is the moment for AWS. This is where, with their dominant force in terms of cloud computing, they should be winning client after client. They're offering you an entire vertical stack of AI. They've got the chips that they, of course, have their own as well as NVIDIA's. They can offer you large language models, their own, as well as, maybe a DeepSeek model, should you wish. They're also offering you the compute that you can use, and it's going out to business after business, the startups and the big caps. But this does take money. $100 billion worth is what they're going to invest this year. They're already cranked up $26 billion of spending in their fiscal fourth quarter. But that is the run rate you have to see to have them match that sort of level of demand, Manus.
I mean, if you look at what's expected to be spent this year, Caroline, $280 billion. So there's no stepping back, even after DeepSeek. But they've all got capacity constraint. Amazon, Microsoft, Alphabet. The question is, how quickly can they fill that gap?
And I think there is so much optimism today. I know the shares don't reflect that, and they're down about 2%. But analyst after analyst is re-rating this stock. The price target higher. We've got the only single sell rating on this stock has capitulated. Morningstar have now brought it to a hold. So they've got 0 sell ratings, 79 buys. And the price targets by Wells Fargo, whether you're seeing over at Morgan Stanley, whether you're seeing it at every single name, is re-rating the price target higher. This is jam tomorrow, not today. They are reinvesting.
And the thing is, we have to remember that, right? Because we've seen that with many of these names. They've had a run up into earnings. Yeah. Microsoft, a 30% run up.
So right.
And so they sell off just a little bit, maybe on earnings, but 2.6%, it can be, it can be a little profit taking. Will these companies, though, end up paying for this huge amount of capex? I mean, we've something like $300 billion between 4 or 5 companies promised for this year, $500 billion promised for the next 3 to 4 years.
Bloomberg Intelligence, the credit analysts over there, saying, I like the use of phrase de minimis, considering de minimis is where we're all thinking about the competition from China, but they're saying de minimis impact in terms of credit rating when you're thinking about the amount that they're spending. These companies are cash rich. They've got so much money that they can be investing. Sure, it means that the operating profit that comes in at more than 60% for the fiscal fourth quarter gets pulled back a little bit. But really, you're still getting profit handed to you. You're still getting revenue growth of in excess of 9%, potentially 8% for the next fiscal quarter. And they are still able to re-evaluate and reinvest. So yeah, you're right. There is a question of the Herculean amount of money that's going in. But of of all the companies out there, these are the ones that can spend it.
Well, I tell you what, take a look at Meta. It's up for the 15th day in a row. I mean, it's just blasting through. It's like one thing after another. Caroline, we'll see you a little bit later on. Caroline Hyde there with the very latest on the technology story. Let's begin the investment story with the BMO Wealth Management, Investment Management Officer, Young Yu Ma. Young Yu, great to have you with us this morning. We've got the jobs report. Wages are hot. Unemployment is low. The tech companies are all preparing to spend more. How embracing of risk are you right now, given everything that's been thrown at this market since President Trump took to power?
Thanks, man. It's great to be here. Yes, we are embracing a risk here. We do think the market has shown quite amazing resiliency, and we think some of these trends that are taking place, such as you see today with Amazon spending, other mega cap tech companies spending, that's really going to have a significant impact on the economy, as will AI rollout and productivity trends this year. So we think the underlying backdrop is quite favorable, but we do, of course, recognize that disruptions can happen at any time from tariffs, and there could be volatility along the way, but we think the economy and the markets can withstand that.
What is the primary concern of your clients right now? Is it, the AI, I don't want to say bubble, but the AI enthusiasm might be starting to fade? Is it something about the Fed or the new administration?
I think the primary concern still probably revolves around tariffs. That's both from the business standpoint and the consumer standpoint, and the uncertainty that creates. Businesses not knowing where they should be investing, when they should be investing, how aggressively they should be investing, and consumers worried about will there be another price spike that takes place. So I think the biggest issue with tariffs is probably the uncertainty issue, maybe even more so than the actual results that play out or implications from tariffs that might come to be. The uncertainty that is created right now is probably going to lead to a bit of a pause, both by consumers and corporations, until this gets resolved.
With that in mind, though, what we've seen in the bond market right now is coming down in terms of yield. We just finished a conversation with Rick Reeder there. We're down for 4 weeks in a row. We've given a little bit back this morning on the back of the strong jobs report. How important is that dissipation in yield to pick up duration stocks?
Well, I think long-term yields staying around the levels where they are now, being relatively stable, is helpful to the markets. We don't want long-term yields running away to the upside. We don't think they will. We think the forces that would push yields up versus those that would push long-term yields down are relatively balanced here. But we do think that's an important key metric right here that we're looking at that indicates whether or not the market can remain stable, or whether or not we see too much of a push to the upside, which might pressure those longer duration stocks. We don't think it's going to happen. We don't see the labor market pressures accelerating, even despite some of today's numbers. And we actually think that some of the softness that might take place in the labor market could come forward, or could come forth in the coming months. So we think we're in a good spot here, actually, with respect to yields.
Is it a time to stay in the risky assets that we've seen doing well, the Magnificent Seven, perhaps some crypto-related stocks and so forth? Or is it time to rotate, Young Yu?
Well, we do think the market's going to be a bit more discerning here. Certainly, the mega cap names have such a strong high weighting in the index that it's hard not to be invested in them with any sort of index tracking that someone has. But in terms of what some of the recent developments in news have signaled, I do think we're in a phase where we're shifting to more of a software focus, away from a hardware focus. The good news is that you do see the spending being continuing to be robust, and these mega cap tech companies really accelerating their hardware spending. So we don't think that's going to let up a lot, but we think a lot is priced in there. And really the next wave are some of the applications that consumers and companies start to use and roll out to gain efficiency. So we think there's a shift that's taking place underneath the hood there, and that's something that investors should be aware of. And
that's the shift from, enablers to adapters, and therein lies the productivity conundrum. Do you think that productivity uplift comes as soon as this year, and what is the consequence for that in terms of investment?
Yeah, we absolutely think it's going to come this year. It's already started quite robustly in terms of anecdotes, and the next stage is going into the data and the numbers and the profitability that companies see. That might be a couple quarters out before those numbers are obvious and strongly apparent, but we do think that's underway right now and will be more underway throughout the rest of the year. The implications for investors is I think that's one reason to be optimistic here. And even if we get volatility, even if we get tariff news that's disruptive or might give the market higher uncertainty for a month or two, those underpinnings that support profitability, that support growth, and that support corporate health are still there. What does it mean for the labor market, though? The labor market is probably going to be relatively muted despite this growth. So we're not going to get the inflationary pressures, but we're also not going to get aggressive hiring as companies grow.
Young-Yu, thank you so much for joining us today. That is BMO Wealth's Young-Yu Ma. Coming up, the shine seems to be coming off e.l.f. Beauty as it lowers sales guidance. We'll discuss what's next for the cosmetics company. This is Bloomberg. Time now for our top calls, some of the analysts to action in focus this morning. We begin with Citi downgrading Nike to a neutral. That analyst says that 2026 is not shaping up as an inflection year, and he doesn't have the, quote, patience or conviction to wait another year. He's just not doing it. Next up, Deutsche Bank is upgrading Honeywell to a buy. The conglomerate announced yesterday, obviously, that it's going to split into 3 separate companies, following pressure from at least one activist investor most recently. And finally, Morgan Stanley cutting its rating on e.l.f. Beauty to a neutral after the company lowered its sales and profit outlook. The analyst says e.l.f.'s small size and volatile track record increases risk, and that company is losing a quarter of its market value right now. It is a terribly volatile stock, but today it's a particularly tough time for e.l.f. Eyes, Lips, Face. Let's discuss the company now, though, and its outlook with Bloomberg Intelligence senior consumer analyst Lindsay Dutch. Lindsay, it's interesting because Morgan Stanley came out and made these comments. Obviously, the market is not taking the softening outlook and the soft January well. But Piper Sandler says it's struggling not to come up with a scenario where things go well for e.l.f., that the math just doesn't add up, even e.l.f.'s own math.
Yeah, so I can understand that. So the company, they have grown sales at a tremendous rate over the past 2 years. They're continuing to gain market share. Even the third quarter, the top line beat and they grew by 31%. Their guidance, they cut the annual guide. It was only a slight cut, but the big concern is this is a brand that has bucked the broader trend for over a year now. And so there's concern that this popular brand is now going to be feeling this softer beauty demand. But if you dig in, what they're implying for the fourth quarter, down 1% to plus 2% growth, that's a massive deceleration from 31% growth in the third quarter and 77% last year. So I can understand, thinking about those pieces, is there a possibility that the fourth quarter is better than they're expecting?
So, Lindsay, good morning to you. We're going to speak to the team from e.l.f. in just under an hour. The risk here is that they then spiral into an inventory build-up. They have to cut prices. They're one of the major brands out there on the shop floors here in the United States of America. What are they going to say to the market to convince them that they can put a floor under this?
So I don't think that they are going to cut prices. I don't think that would be how they sort of manage, reigniting demand for their brand. They are very big on social media. They have a very strong Gen Z following, and they have really pushed on that marketing lever for the past 3 years now, and it has worked for them. And so I think they will try to really lean into that marketing and try to get the brand back to being that viral sensation that it has been over the past 2 years. I would also say the guide, is based on soft demand in January. And they're assuming that trend persists through the rest of the fiscal quarter. There is a possibility for some strength in February, with Valentine's Day, with people going out. There is opportunity for that demand to come back and come back fairly quickly.
Yes, we need that lip oil for Valentine's Day, that's for sure. The average price product on an e.l.f. product is $6.50, Lindsay, and that's partially because 80% of its supply chain is located in China. Will that change if tariffs go on and stay on?
Yes, so they are the master of the dupe. They are offering low price products that do very similar things that very expensive product will do. They had actually raised their prices a couple of times, one of which they raised almost all of the SKUs about 2 years ago, sort of to combat, the higher costs that they were dealing with, with their supply chain in China. I think, a big concern with, raised tariffs, their costs are going to go up again. And their first lever would be to actually increase their prices. They have a big enough gap, with that average $6 price versus a higher price brand. But that move gets a lot harder to execute if demand is weakening. So I think, there's we're at a crossroads here, if raising prices is the move to preserve margin, but demand isn't great, they might have to come up with something else. But diversification would be really difficult to do at a very rapid pace.
Well, we're going to be asking the CFO in just a few minutes. Thank you, Lindsay Dutch of Bloomberg Intelligence, for all of that context. That stock down about 21% now. And coming up in the next hour, as I'm saying this, we are going to be speaking with the CFO of e.l.f. Beauty. That's at 10:30 Eastern, right here on Open Interest. This is Bloomberg.
It's Bloomberg Open Interest. Quick check on these markets on Jobs Day. You saw wages come in hot, unemployment dropped to 4%, up a little bit on the S&P 500 at the moment as yields roll low, as the yield market shifts ever so slightly. So this is about the strength in the employment market, despite a little bit lower on the headline jobs number for the moment. As you can see, the Nasdaq up 0.3%. Well, President Trump is taking aim at carried interest, the loophole. It's a favorite tax perk for private equity firms. And that is the topic of today's Wall Street Beat. Alison McNeely joins us around the desk. Good morning, good to see you. Look, for as long as I've ever been involved, or Wall Street has ever been alive, people have been talking about taking away carried interest. Why is it that the president thinks that now is the political moment where that actually can work? Is it a real threat?
I mean, it's been a political football, as you've noted, for a long time. Both Democratic and Republican presidents have tried to sort of end this tax perk. Mm-hmm. It's important to keep in mind that President Trump sort of rode a wave of populism and anger about the cost of living in the United States, and really kind of bringing this topic back to the forefront, something that is very unpopular with a lot of voters, is sort of a way to kind of say, hey, I hear you, here's an idea of how we could make things a bit more equal.
It's so granular, though, that you think the average voter wouldn't possibly dive into the details of carried interest and what it means and how people get compensated and why it's important, because that's, you know, how you raise revenues and so on. It was key, though, during his 2016 campaign. He didn't really mention it this time around, did he?
Exactly. He tried to do this previously, and ultimately, after fierce lobbying on behalf of the private equity industry, you know, they kind of backed off of this, and it didn't make it into sort of the tax changes last time. the private equity industry really says, the carried interest tax break is an important sort of incentive for the way the industry operates. These firms, these investors take a lot of risk and invest in companies that create jobs. And in order to be sort of fairly compensated for taking that risk, they should get preferential tax treatment.
So wouldn't somebody like J.D. Vance be, not behind this? I mean, he is for small business creation and for, helping the little guys, and he came from that background.
I mean, I can't speak to what J.D. Vance might think about this, but, you raise a really interesting point that there are sort of people in different sectors of the Republican Party and the Democratic Party that feel differently about this issue, whether, they're maybe more on the populist side or less so, and it'll be interesting to see how this plays out.
This comes down to the weight of income, the income split between your basic income, your bonus, but also carried interest for a lot of these private equity firms. Just give us a sense of the tilt and the shift towards, that part of the remuneration over the past couple of years.
Right. So at the biggest publicly traded private equity firms, so your KKRs, your Carlyles, your Apollos, we've seen those firms really change the way that they pay their senior deal professionals to orient their pay more towards carried interest, taking home their share of profits from deals and less away from the management fee stream. And by doing that, they're able to leave the management fees for public shareholders. As publicly traded companies, they're very concerned about, making sure those numbers are trending in the right direction, helps the stock price, makes their shareholders happy.
He also separately wants to end the special tax breaks for billionaire sports owners, which is another demographic I would have thought he would want to keep on his side and want to keep happy. But obviously, the amount of money he's going to raise, it's all going to be worth it. Is that what the case is?
I mean, that's a great question, and I think we'll have to see how that plays out. But you are right. There is sort of a tension there at play between sort of where he has gotten his support and some of these measures, and whether or not they'll make people happy.
Yeah. All right. Well, we'll see in the next few weeks. Alison McNeely, thank you so much for keeping us up to date on all of this. Coming up in the next hour, we're joined by the CEO of FICO. This as more and more Americans adopt buy now, pay later. Plus, the CFO of e.l.f. Beauty joins the show. Let's take a quick look at how markets are faring now that we are 25 minutes into this trade. We're seeing a nice little rally on our hands. Crypto-related stocks are doing extraordinarily well as that currency, cryptocurrencies, Bitcoin in particular, just tops $100,000 a coin now. But the S&P 500, as you can see, up 0.25%. The NASDAQ 100 up 0.3%. Small to medium-sized businesses doing a little less well, but still in the green. The Russell 2000 up 0.1%. And that 10-year yield staying higher by more than 5 basis points after the jobs report came in. Perhaps a touch lighter than expected, but the unemployment rate went down and average hourly earnings were also up 0.5%. So a Goldilocks to good jobs report. Stay with us here on Open Interest. This is Bloomberg.
30 minutes into the trading day. Welcome back to Bloomberg Open Interest. I'm Manish Cranny.
And I'm Bonnie Quinn, Matt Miller, Katie Greifeld and Shonali Basak all off today.
But we'll keep you fresh and up to date with these markets. 30 minutes into the trading day. One big belter is, of course, Meta at the bottom of your screen, up 15 days in a row. We are taking our lead really from the wages component and from the unemployment rate in the jobs report at 4% on the unemployment rate. But we also have breaking news on the University of Michigan Sentiment Index. Let's get straight to Mike McKee, our Chief International Economics and Policy Correspondent on the data. Mike.
Yeah, jobs report a little better than expected when you look at the underlying numbers, but this Michigan number, all of them are pretty terrible. The University of Michigan sentiment falls to 67.8 from 71.1. The current conditions index 68.7 from 74, and expectations 67.3 from 69.3. So people are not at this point seeing a lot of strength in the economy, but they are seeing inflation. This is really, really interesting. The Michigan one-year inflation number jumps to 4.3%. Wow. That is a 1 percentage point gain in one-year inflation expectations over the January number. 5 to 10-year inflation goes up just a tick to 3.3 from 3.2. But these numbers, we'll have to go under the hood and see exactly where people were upset. But these numbers are not particularly good news for the Fed or for the administration.
And in terms of that one-year inflation expectation in particular, 4.3% up from 3.3% and an expectation for that to stay the same. Does this have any indication at all that we might be coming unanchored?
You know, if it continued that way, you'd say that, and certainly the size of the move gives you something to be concerned about. Whether it's unanchored or not, it's hard to tell when you have just one data point.
It's quite jarring for the bond market, isn't it? If we look at 10-year government bond yields, we're at 4.49 now, so we are spiking higher. There's the Russell, there's the bond market for you. We went into this with a really strong wages and unemployment number from the non-farm payrolls. So this is going to spook us slightly ahead of the CPI next week, isn't it, Mike?
It's hard to explain, not because it's complicated, but because economists don't have a really good answer. But basically, people are, on a macro sense, the numbers are good. But apparently, at the local sense, when you're talking about yourself, people are thinking things aren't.
But this is prescient for the Fed, because the five-year horizon is what really matters for the Fed, isn't it?
Yes, and although they're concerned in terms of becoming unanchored with the 1 year, because that's much more volatile, and the fact that it moved this much is surprising. But then you look at the jobs report, and 143,000, not all that bad, especially if you're averaging, because the December number was 307,000, 4.0% for unemployment, also good, because at this point we're not seeing a weakening in the labor market that's going to bother the Fed and lead them to cut. And then you look at the average hourly earnings up 0.5% and pushes it up to 4.1% on a year-over-year basis, still well ahead of inflation. So the economy is still strong, and it's just that people are worried about it, which is a kind of interesting development. It may be, and I don't want to go too far down this road, but it may be politics. It may be people worried about what's going to happen with tariffs. It may be worried about the U.S. invading Greenland or something like that.
Yes.
But there is some concern.
Well, Michael, thank you. We'll speak to Julia Coronado about all of this in just a second. That is Bloomberg's Michael McKee. And a reminder, Michael will be sitting down for a Q&A with Joanne Su, the head of the UMich Consumer Sentiment Survey, in just a few minutes. So you definitely want to tune into that, particularly after today's numbers. You can do that via the terminal. Well, joining us now is Julia Coronado, Macro Policy Perspectives President and Founder. Let's get straight to that one-year inflation expectations out of UMich, 4.3 versus 3.3. Is this a concern, Julia?
It's definitely something that's going to go on the Fed's watch list. I agree with Mike that it does seem that the threat of tariffs and the discussion of tariffs has risen to the consciousness of Americans, and they're concerned about the impact of higher prices in the near term. But even the longer term inflation expectations ticked up a little. So again, one data point, nobody's going to panic over this, but combine it with a strong jobs report, and the Fed's really not going to have any urgency to make that next rate cut anytime soon.
Good morning to you, Julia. And this is what's going to come to the fore next week when we hear from Powell. It's going to be interesting, even more so now, what he's got to say about the inflation side, because this was one of the progressive points for them. But you think this reinforces the risk of no cuts this year?
That's certainly a risk. It's very early in the year. I mean, the other thing that the weak sentiment number, the other risk that raises is that consumers might pull back their spending. Now, again, we saw that they have jobs and the job market is generating real wage gains. So purchasing power is in solid territory. But if consumers get very concerned about the future or worried about trade wars, they might get more cautious in their spending, and that could weaken the economy and ultimately weaken the job market. So there's a lot of possible scenarios for the year ahead. And again, for the Fed, all this does is say, just hold your fire, take some time, let things unfold. The economy is giving you the space. I don't think that, that next week's data is going to show a big surge in inflation necessarily. It's way too early for that. But at the same time, we haven't seen the progress that we had been seeing. It kind of stalled out a little bit towards the end of last year. So again, just caution, patience, and wait and see for the Fed.
Well, the market reaction is really fascinating because it had been sailing along nicely after the jobs report. Julia, the equity market was in the green. Most of the groups in the S&P 500 were in the green. We have that now flipped. It's been reversed, and we have the major indices all lower. However, the 10-year yield is still at 4.499 roughly percent. So there hasn't been much movement in the bond market following the UMich sentiment data. So is it an indication perhaps that equity market investors feel like maybe the consumer will change their behaviors? However, the Fed won't have to do anything, just like it wasn't going to have to do anything after this morning's jobs report.
Yeah, I mean, I think you're highlighting that there's risks in both directions here. Risks that the consumer's spending gets more cautious would certainly not be great news for the equity market, but it would also potentially not be great news for the broader economy. And that could actually point to a need for the Fed to lower rates later in the year to help boost the economy. On the other hand, if inflation expectations are rising, and part of that is a trade war that actually finally materializes to a greater extent, you might actually see inflation pressures. So those things for the bond market, it could go in both directions, and it really depends on the combination of policies that comes forward and, how resilient the economy is to. The other thing that's, really key is thinking about, we're starting with this very solid, stable backdrop, but we're about to absorb a lot of disruptions. The shutdown in immigration is going to really alter the availability of workers to hire. That's also going to be a source of population growth that's going to go away, and that's going to, also affect spending. And the possibility of significant cuts to government spending and employment is also something that could affect the job market and consumer spending. So we've got a lot of potential disruptions on track that, again, could do different things to the economy and send different signals. The Fed is looking at the risk that their goals could be in conflict this year. Higher inflation, weaker jobs is a hard combination for the Fed to manage.
It is indeed. Looking at the bond market, 449 is where we are at the moment. How much time will the bond market give Scott Bessent to control the yield curve via his energy policy and his deregulation? Because those things take considerably longer than 11 months to come into actual effect, Julia. The yield curve control, your take on that?
Yeah, I mean, it makes me nervous when we start talking about, sort of managing the bond market or managing longer term yields. Yes, the U.S. Treasury has enormous power. We saw the reaction to the refunding announcement, the fact that they're keeping longer term issuance steady certainly was good news for longer term yields. But, it always it's a little unsettling when people start talking about managing longer term yields, which ultimately are the result of millions of investors putting their views to work. Yeah, we'll see how that plays out. Ultimately, if you deliver strong growth and low inflation, yields should be fine.
Yes.
But, you know, I think it's the reality of the economy that's going to drive yields rather than some kind of yield curve control policies.
All right, well, with the 10-year at 449.67 right now, we'll be keeping a close eye. Julia, thank you so much for joining us this morning. That is Julia Coronado of Macro Policy Perspectives. Coming up, new research from FICO suggests buy now, pay later may not impact your credit as much as previously expected. We'll speak with CEO Will Lansing next. This is Bloomberg. Now to high interest, a look at what's making headlines around the world. A plane carrying 10 people went missing in Alaska yesterday during bad weather. According to Alaska's Department of Public Safety, the Boeing Airlines was headed to Nome with 10 people aboard. Rescue crews are scouring the ground for any signs of the wreckage. The accident could make it the third deadly aviation disaster in the United States in just 2 weeks. President Trump is threatening to cut special tax breaks for sports team owners just days ahead of Super Bowl 59. The move threatens to reignite a long-running battle against the NFL and some of America's wealthiest families. Since the American Jobs Creation Act of 2004, team owners have been able to write off a chunk of the purchase price against the team's taxable income over 15 years. Treasury Secretary Scott Bessent is having a bumpy first few weeks in office. He's had to deal with a controversial crackdown on federal spending and the threat of President Trump's tariffs. In an interview with Bloomberg TV yesterday, Bessent tried to dismiss ideas that Elon Musk's Doge was interfering with the Treasury.
There is no tinkering with the system. They are on read-only. They are looking, they can make no changes. It is an operational program to suggest improvement. So we make 1.3 billion payments a year. And this is 2 employees who are working with a group of long-standing employees.
Treasury Secretary reassuring the markets. Will Fair Isaac Corporation, better known as FICO, reported their quarterly results earlier this week that fell below the market's estimates. The company's known for their credit scores, recovered after the initial sell-off, with analysts remaining positive on its longer-term potential. Pleased to say that the FICO CEO, Will Lansing, joins Vonnie and I now. Good to see you, sir. Welcome to the show. Looking through the broker reports, I see one of them saying, look, this was a rare event for your company. I want you to quantify the rarity. And how assured are you that that's what it is, a one-off event?
Well, I think it's very simple. A lot of our revenue and profit is tied to mortgage volumes, and mortgage volumes are obviously tied to interest rates. And so the numbers are actually fine so far. But I think that everyone believes that interest rates won't come down quite as fast this year as, say, 6 months ago they believed. And so I think that's some of the impact. But our business is really solid. I mean, we're no surprises for us. We're right on track in terms of our guidance. We're reaffirming guidance for the future. We feel pretty good.
Interestingly, you've paired with a firm and you've done a study that suggests that buy now, pay later is not actually negatively impacting credit scores.
Well, buy now, pay later is probably a positive for credit scores, because anytime you can get alternative data, additional data into the calculation, some people are going to benefit from that. And buy now, pay later is one of those categories where, previously it wasn't really considered. And if there's good payment behavior in buy now, pay later and it gets incorporated in the score, you're going to have people who have better access to credit as a result.
I'm curious, Will, in terms of who is taking up the buy now, pay later. It's something I maybe would have used when I was much younger. Thankfully, life has changed. So what is the complexion of people who are picking this up and using the product?
It tends to be people who are a little more hungry for credit, subprime, some of the lower credit score bands, because it's easier for a lender to make a buy now, pay later loan, understanding exactly what the purpose is, and the payment behavior is good with buy now, pay later. And so it's opening up access for people who probably wouldn't otherwise have it. Maybe they don't have as big a credit line as they'd like, but they have an opportunity to buy something with a buy now, pay later approach that winds up being incremental credit for them.
Well, Will, let me ask you this. What would it take for a buy now, pay later purchase to affect credit? Is it over a certain amount? Is it one delinquency? Is it one late payment? Is it several? Can you give us some metrics?
The main thing is pay on time. That really is the main thing. Historically, buy now, pay later was not really included in the credit file as a data point to go into the score. And the bureaus have been treating the data differently. There's different approaches. So we've been working with a firm to try to standardize the approach so that we can incorporate the buy now, pay later data into the credit file and make it part of the score.
Well, I want to circle back. We're dealing with jobs day to day. We're dealing with interest rates. We're looking at mortgage rates on the 30-year paper being at 6.8%, jarringly stuck there. How dependent for the next leg up in your business are you that actually rates fall and that this housing market perhaps turns a bit more? In other words, the wheels get greased with lower rates.
Well, we certainly benefit from that. So I think any kind of lowering of rates will result in higher mortgage volumes, which will result in more revenue and profit for us. But that's not the only thing that we rely on. Obviously, we have a lot of innovation. We have a software business as well. I mean, there's other things at work. And of course, mortgage isn't the only thing. So I would say we will benefit from rates coming down, but we're not relying on rates coming down to make our numbers.
How would you describe the mortgage market at the moment? Some people say to me, I'm locked out, I'll never get on the property market. Do you think this housing market is jarred or potentially broken?
Oh, I don't think it's broken. There's no question there's a little less demand when rates are higher. People can afford less, and sellers are still, they still have some expectations about pricing that probably have to be adjusted. So what happens with rates going up? There's a period of time during which the sellers of real estate have to understand that maybe they're not going to get as much as they used to. The buyers have to understand they're not going to get as much as they used to. And over time, those two things come together. And so you reach an equilibrium, even in a higher rate environment, you reach an equilibrium and you wind up with the volumes recovering. People have to move for jobs and they have to buy homes and so on. The refi market's a little bit different because that's really a function of whether there are people who have an opportunity to reduce their mortgage payments by refinancing.
Yes.
And when we're near historically high rates, at least over the last decade, when we're near historically high rates, what happens is you have less refi activity. But today we're down a little from the peak, and so there is refi activity.
Fascinating. Will, can I ask you how you're using AI in your business and also to help your consumers, your customers, and just the general public that might be thinking about engaging in some kind of a credit activity?
Well, so we've been in the AI game for a very long time, and we're an analytics company, and we got started with neural nets 30 years ago. They drive our fraud detection business, and we use AI in all kinds of places, from code productivity to synthetic data to test things out. What you can't really do today is use AI in underwriting, because the regulators want to have enough transparency that they can understand whether or not there's discrimination occurring. And so they've basically said, look, AI is a black box, and if we can't explain how the decision was made, we can't use it in underwriting. That's the challenge of using AI in underwriting. In credit underwriting, we're governed by fair lending laws. That said, FICO has a lot of innovation in this area. We have patents, and we're very focused on ethical AI, explainable AI, and the ability. We have a patent on using blockchain to provide an audit trail so that you can understand how the AI got to the decision that it did. And I think that's going to open up doors in the future for using AI in underwriting. But until then, we'll use it the way a lot of other companies use it.
Yes.
Okay, interesting take on the AI front there. Will, thank you very much. Will Lansing, the FICO CEO. Still ahead with Vonnie and myself. Vanguard putting pressure on its rivals by unleashing record fee cuts. We'll hear from the CEO. That's next on Bloomberg.
if you go back to our origins, what Bogle was against was high fees. And so active management at a low fee can really outperform over the long term if delivered with the right quality. That was Bogle's hypothesis in the 70s and 80s. And if you look at our track record, even just in something like active fixed income, the empirical evidence backs up that hypothesis that he had way back then. 91% of our active fixed income outperforms its peers over the past 10 years. And one of the reasons why is because we price it at just over 10 basis points. And so at a very low fee.
CEO of Vanguard, they're speaking to Katie Greifeld. This week, Vanguard slashing their fees for dozens of mutual funds and ETFs in a record move that sent shockwaves through the entire asset management industry, rocking up the prices there. Quick snapshot on markets. Now, what you've got to consider here is the inflation expectations, Vonnie, from the University of Michigan. The one-year numbers coming in 100 basis points higher than we anticipated. So 4.3% versus 3.3%. And you can see that short end of the curve shooting higher, along with duration.
Yeah, I mean, that was a huge difference. And even the 5 to 10-year expectations were up a tick. So not exactly what you want to see out of that data. Coming up, shares of e.l.f. Beauty taking a tumble after the cosmetics brand warned of weaker demand. We'll discuss with e.l.f. Beauty CFO Mandy Fields. That's next. This is Bloomberg. One stock we're watching this morning is Elf Beauty. The stock's sinking after the company cut its full-year projections for sales and profit. Elf citing softer than anticipated January trends for the weakness. Joining us now with more is Mandy Fields, CFO of Elf Beauty. So a tough day for Elf, Mandy, but can I ask you how you came to the math of all of this, right? Piper Sandler is saying they just don't see it. They don't understand why the guidance is, you know, this perplexing, that they feel like you're going to put up another beat.
Well, thank you so much for having me. First, I'd like to say that I'm very proud of the team and what we delivered in Q3. We just delivered a 31% net sales growth quarter and are outlooking 27 to 28% growth for the year. So still very strong performance we're expecting for this company. We decided to lower our guidance just based on what we're seeing out of January. We did not see the category in a position of strength. It continued to get worse into January, particularly on a two-year stack basis. And we felt that consumers' minds share was elsewhere. If you think about if you think about influencers, content creators, all of the beauty conversation was really muted in January. In particular, in the LA area where we had the wildfires, we really believe that consumers' mind share was somewhere else.
Well, there's that to contend with then. There's also the prospect of tariffs for a company that sources 80% of its supply in China. How have you started to potentially think about diversifying, if at all?
Well, we believe we have a playbook to mitigate the impact of tariffs. Since 2019, we've been subject to tariffs at the 25% level on anything we're importing from China. And we have several levers at our disposal to help mitigate the impact of those tariffs, including working with our suppliers on cost savings, cost concessions with our suppliers. Foreign exchange typically moves in our favor in this type of environment when we think about the RMB. And additionally, to your point on diversification, we have diversified our supplier base. If I think back to 2019, we probably had 99% of our product coming from China. Today, it's closer to 80%. So that's progress that we've made in addition to diversifying our sales base. Today, 20% of our sales actually come from outside of the United States. And when we import into the UK or into Canada, we are not subject to those tariffs. And so between all of those levers, we do feel we have a playbook to help offset.
Mandy, good morning. Good to see you. A tough day for the stock. This market wants reassurance from you that there's something more for you to do than just social commentary. So how do you fix the response mechanism to January? Do you spend more on social media? What is the fix to the headwind you've just seen?
Well, the fix is staying focused on our four areas of opportunity, white space opportunity that we still have ahead of us. We believe that we can become the #1 brand in color cosmetics. We've made progress over these last 6 years that I've been here as CFO. We are now the #2 color cosmetics brand and certainly have our sights on becoming #1. We're going to continue to make progress in skincare. We have two of the fastest growing brands in mass skincare with Elf Skin and Naturium. The brand that we just acquired about a year ago. And so we're going to continue to make progress there. #3 is digital. Our digital business was up over 30% in Q3 and is a big growth driver for us. We're the only mass cosmetics brand with our own direct-to-consumer site. And so that is something that we're going to continue to focus on, as well as international expansion. Only 20% of our sales come from outside of the U.S. versus over 70% of our peers have sales, their sales coming from outside of the U.S. So it's a big opportunity for us, and nothing has changed for us from a strategic standpoint. We're going to continue to focus on those and control what's in our control.
Mandy, margins do appear to be under pressure, flat to slightly lower even. How do you anticipate increasing margins at a time where you may be facing higher costs yourselves? Can you push that onto a consumer that is very, very happy to spend $6, $6.50 on a product?
Well, I can say in our latest guidance, we actually took our gross margin guidance up to 40 basis points. So it's continuing to expand our gross margins. From an EBITDA margin standpoint, we're going to continue to invest in our people and infrastructure. As I said, we have a number of white space opportunities to go after, and we want to make sure that we're investing in that growth that we see on the road ahead. And so I'm very pleased with where we're landing. 23 to 25% growth in adjusted EBITDA this year is our latest outlook.
Mandy, you very eloquently laid out how you've reduced your exposure to the supply chain to China. But most manufacturers here are going to have to make a tough decision. If I have tariffs, do I pass on the full tariffs to the U.S. consumer? What will you do?
So in the 2019 scenario, and part of our playbook, we did take select price increases. Now that's something that we are very mindful of, given that our value proposition is very important to us. And so it's certainly something that is in our toolkit to leverage, but certainly want to be mindful of that, particularly in an environment where you could see inflation kind of start to go back up for the consumer.
How about store openings, new stores, maybe expanding the footprint? Do you anticipate doing that, especially because it might actually help to offset some of the problems?
Yeah, we certainly continue to expand our footprint with our retailers. We just talked on the call about expanding our space at both Target and Walgreens this spring, so that's coming up. And we have a number of opportunities internationally, as I just talked about, with only 20% of our sales outside of the U.S., a lot more retailers for us to go after and make sure that e.l.f. is getting into the hands of every eye, lip, and face.
Every eye, lip and face, I love it. Mandy, thank you so much. That is Mandy Fields, CFO of e.l.f. Beauty. Let's get a look now at some other stocks moving at this hour. Amazon issued disappointing earnings guidance and warned it could face capacity constraints in cloud computing, despite plans to invest some $100 billion this year. Expedia, meanwhile, posted better than expected gross bookings in the final months of 2024, reflecting resilient demand for travel during the winter holiday season. And Nikola is exploring a possible bankruptcy filing, according to people familiar with the matter. This follows a tumultuous period in which the electric truck maker has swung between stock market darling and scandal-plagued enterprise.
Well, coming up, the U.S. adding fewer jobs in January than was expected, according to the latest jobs report. We'll discuss how the Trump tariffs could also take a toll on the labor market. Wall Street Week host David Westin sits down with the former U.S. Treasury Secretary Larry Summers. This is Bloomberg.
Time now for our daily Wall Street Week conversation. Today we're focused on the payrolls report. US job growth moderating last month, showing a moderating but still healthy labour market. But what impact could President Trump's proposed tariffs have on US jobs? Wall Street Week's David Weston put that question to former US Treasury Secretary Larry Summers.
When people pay higher prices because of tariffs, they have less money to spend on goods other than the tariff jobs, and that hurts jobs. So it's very hard to know which way the effect will go or whether there'll be any positive effect. It depends in part on what the Fed does, but the idea that protection is some kind of solvent that creates large numbers of jobs, I don't think would be supported by most economists. After all, if that were right, Argentina would have had a great record through the years at having low unemployment.
What's the best case for Donald Trump's argument for tariffs? You sometimes agreed with him, sometimes actually disagreed with him. But what's the best case you could make for President Trump's case on tariffs?
Look, I think the argument is that it's a negotiating tool and that there are important things that we want to achieve in negotiation. Whether we will achieve those things, I think very much remains to be seen. Whether the aggressiveness with which we've pursued this strategy will ultimately make cooperation with other countries more difficult, that remains to be seen. But I think the best argument for this approach is a set of considerations based on leverage. And of course, there are also arguments for specific tariffs in specific sectors that are directed at ensuring that our economy is adequately resilient. I certainly feel much better about the situation with the tariffs suspended and negotiations underway than with the tariffs actually imposed. And we're just going to have to watch and see how all this plays out. I do think the United States has gained an enormous amount from an international approach based on international rules. And when we flaunt those rules, we may make it more difficult for such a system to exist. And that may ultimately undermine what our interests are. So we're going to have to watch very carefully.
Larry Summers there speaking with David Weston, and you can watch Wall Street Week tonight and every Friday at 6 p.m. Eastern. This is a little bit more on the first U.S. jobs report under the Trump administration. Joining us now is Balance of Power co-host Katie Lyons from Washington. Katie, of course, Jonathan Lamry caught up with Mr. Hassett straight after the numbers, and he went straight to the politicization in terms of the adjustment in these numbers and that employment may well have been adjusted by almost 1 million. Straight into the kill on the politics of the jobs report, wasn't it?
Well, absolutely. And the politics on this, man, are a bit mixed because this is a split jobs report. The first 20 days of January were under technically the Biden administration and the remainder of the month under the Trump administration. But the White House today, Kevin Hassett included, but also via a statement from the press secretary, Caroline Leavitt, is really putting blame for the weakness in the headline payrolls number on the Biden administration. They say today's jobs report reveals the Biden economy was far worse than anyone thought, going on to say it underscores the necessity of President Trump's pro-growth policies. The thing is, as we consider what the labor market will look like going forward, the impact those policies will have is very much a question, not only when we're considering the deportation efforts already underway in these first few weeks of the administration and what the changing immigration and migration demographics may mean for the U.S. labor market, but also when it comes to things like the federal government layoffs that they are trying or resignations that they are trying to pursue as they try to shrink the federal workforce through incentives via a buyout that people now have until Monday to accept after a judge delayed the deadline and our warning of layoffs if not enough people take that. So the changing federal government, the changing migration dynamics, all of that ultimately could filter its way into the data that we're getting out of the Bureau of Labor Statistics and impact the way in which the job market will be molded going forward.
For sure. And Kayleigh, just, on a separate matter, President Trump met with Republican lawmakers yesterday and the carried interest deduction came up. And, we hadn't heard about that too much this time round, this campaign round, but he's definitely bringing it up and trying to use it as leverage and as a reason, to allow then the tax cuts to stay in place.
Yeah, this was a new idea introduced by the president, Vonnie, at least new in terms of what he had been pledging on the campaign trail, though he did reinforce that those are his priorities when it comes to tax policy as well. No tax on tips, overtime, Social Security. And yes, he does want to see the SALT cap raised. So all of that is what House Republicans were trying to work through with him and together at the White House yesterday. And the speaker did emerge after that hours-long meeting saying that they did have a framework. But we learned from the speaker today that we're not going to get actual details as to what that plan actually looks like until the end of this weekend or possibly even Monday. And in the meantime, the president is going to be meeting with Senate Republicans at Mar-a-Lago for dinner tonight. And the Senate is pushing a different strategy than the House. They want to see budget reconciliation bills split up into two. The Senate Budget Chair, Lindsey Graham, is hoping to move ahead with a first part next week that would just focus on energy and the border and defense, saving tax policy for later, while the House, with a very slim majority, thinks if you want to get tax policy done, you have to fold it into one big package with everything else. So it's going to be a matter of who ultimately gets to move first as the House is trying to hammer out these details. And I would point out that the Speaker of the House, Mike Johnson, will be with President Trump on Sunday in his state of Louisiana as they both attend the Super Bowl in New Orleans.
Yeah, well, it's counting down to that and all of the fanfare around it. Can we pivot to foreign policy for just a moment? There is a global leader, the Prime Minister of Japan, meeting President Trump today. This is going to be a very interesting threading of the needle, given what's happened with U.S. Steel and with what Trump has actually said. Japan was rough on us.
Well, that's absolutely right, Manis. It is noteworthy that this is only the second foreign leader to visit the White House so far in this administration, the first being earlier this week, Israeli Prime Minister Benjamin Netanyahu. But Japan coming second does show how important this relationship is. This is the first time that President Trump will be meeting face-to-face with Prime Minister Ishida. And there's going to be a number of things on the agenda, and we could hear more about them when the two have a joint news conference after their meeting at 1 p.m. Or so Eastern this afternoon. Some of it does have to do with countering other players in the region, specifically China, as well as North Korea. Japan may want to bring up concerns around the Taiwan Strait as well, but a lot of this could be economic as we consider Japan's trade surplus with the U.S., the distaste that the president does have for what he views as unfair trade balances with the U.S. and other countries. So trade could come up. And then, of course, U.S. Steel as well, given that Nippon Steel deal was blocked under the Biden administration. And can he extract some kind of difference in opinion from President Trump, who was largely singing the same tune as Biden when it came to that deal, will remain to be seen. But this is going to be a very important press conference that takes place at the White House this afternoon, not only to shed insight as to what this relationship with a key U.S. ally is going to look like, but also because we've seen in recent weeks Donald Trump does tend to make a lot of news at these press conferences, and subject matter could be wide-ranging.
Kayleigh, thank you so much. That is Balance of Power co-host Kayleigh Lyons in Washington. We'll be following all of that, and you can catch that full interview, by the way, with Kevin Hassett from earlier, Director of the White House National Economic Council, on Bloomberg.com.
The Biden jobs market was way worse than markets thought, and that's sort of consistent with the rest of our views that their policies were unwise, and there's a lot of cleaning up to do. And I think that if you look at ISM that just came out, that market participants believe that President Trump is going to be able to turn things around, and with these big downward revisions, we can see that there's actually a lot of work to do.
Well, what would Super Bowl Sunday be without chicken wings? Tyson Foods is hoping to have all of your poultry needs covered. The food giant sells more than 5.5 billion chicken wings a year. And for this Sunday's game, it's rolling out specialty nuggets for the Kansas City Chiefs. Joining us now is Doug Weeks, Tyson SVP of Innovation and Insights. Do the Eagles do something to you, or what, Doug? Is it just the Chiefs?
That's crazy. No, that's a great question. No, you know, we started doing these NFL partnerships just a few months ago, really in time for the playoffs. And we started with the Dallas Cowboys. The Kansas City Chiefs happens to be a pretty local interest team for a company based in Arkansas. And so what's amazing is we really raced this product to market in time for playoffs. And of course, we're very fortunate that the Chiefs have continued to go on and play well. So we look forward to more partnerships coming in the future.
Yeah, I mean, because you know this is definitely a Super Bowl for conspiracy theorists all around the country. Curious as to what results you found when you looked at, you and YouGov, I should say, did a poll. You looked at whether people prefer boneless, bone-in, flat, and apparently they prefer boneless. Is boneless wings even wings?
You know, so it is funny. There is always a debate around wings and what do people really like the most. And boneless is clearly the number one. Drumsticks or bone-in are really popular. And then there is flats that comes in third. But really what is interesting and what Tyson has really done a great job with is whether you like them fresh and you customize them yourself, or whether you like them pre-cooked, extra crispy, cool flavors. We do a rotisserie flavored wing now, which is great for dipping. We do some other flavors like buffalo and classic things like garlic parm, but we really kind of offer it any way a consumer's looking for it.
Doug, give us a sense of how important this is. I mean, people spent millions of dollars on advertising in the intervals in Super Bowl. What does it actually mean for the business, for you? How important is this kind of a tie-up for you?
Literally, I almost think of this as our Super Bowl as well. If you really think about it, we do about 5.5 billion wings a year. But if you think about the actual day of Super Bowl Sunday is the second largest food consumption day in the year, behind only Thanksgiving, right? All those parties, all those events. And core items there are things like wings, chicken nuggets, and also hot dogs, honestly, another very big business for us. And so those are the three critical things for us. And so, again, you put it in perspective. On that day alone, about 1.5 billion wings will be consumed in the United States. So that puts it in perspective of just how powerful and important it is to us.
Just a general question, because you're responsible for sort of all the innovation that happens at Tyson Foods, and I'm sure a lot happens every year, right? Including, you know, we're now in the age of AI. I'm sure there's been ways you've been able to use AI. Just give it a little snapshot of what new at Tyson Foods we can expect in the next year.
Sure, happy to. So we've got a lot of tremendous success on poultry right now, and you're going to see more and more of that. I'd say what you're really trying to do is play against mega trends. So what we see is multicultural households are driving an interest in much more interesting flavors, more variety, and so that's one big trend. Second, consumers are consistently trying to get more protein into their diets. Right now, we see in the fourth quarter, a recent study, 71% of consumers are looking to get more protein incorporated into their diet. That's up from 59% only 2 years earlier. So that's led by interest in things like GLP-1 dieting. And so you'll see more and more products that are designed for those types of consumers, not specifically, but with those kinds of consumer needs in mind. And then you're also seeing I'd say a bifurcation in the economy between an interest in value products and also super premium. And that super premium is really led by the large number of 1- and 2-person households in this country. So when you think about it, 65% of households are 1- and 2-person households. They might be buying less, but they're looking for more premium offerings. And so you're going to see a lot of things in that area. I'll give you an example outside of chicken, just within the Jimmy Dean business, which happens to be America's largest breakfast brand. In the last year, we've launched griddle cakes, which are phenomenal tasting pancakes, meat, egg, cheese, etc. We've seen chicken biscuits just launched a couple months ago, and you're going to see more and more of those kinds of very high protein, nutritious items coming in that brand. And then under the Hillshire Farm brand, typically a deli meat kind of a business or a lunch meat business, you also see things like snacking, dips, and spreads, completely new categories for the business. So exciting time.
Yeah, it's a lot of new.
We're all in there on the chicken nuggets, definitely for sure. Vanya and myself, we're counting down
wings,
to the Super
Manus,
Bowl. She wants wings, and she wants boneless wings or no. We're not going.
I'm not saying, a girl never says, and I'm not saying what team I'm wanting to win either.
Oh. Well, we'll be tuned in Monday morning. Danny will be back. We'll take you through the results. Look, these markets, they really are spooked by these Michigan inflation numbers. Inflation being pumped up by 100 basis points. And stocks, take a look at the NASDAQ, down over 1% at this juncture. So a bit of a turnaround.
From the heart of where innovation, money, and power collide in Silicon Valley and beyond, this is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, I'm Caroline Hyde.
And I'm Jackie Davalos in San Francisco. This is Bloomberg Technology.
Coming up, Amazon plans to spend at least $100 billion this year to keep up with AI demand. We break down the earnings. Plus, U.S. Treasury Secretary Scott Bessent says Elon Musk's Doge effort isn't altering Treasury systems. More on our exclusive interview. And with the Super Bowl this Sunday, we dig into the sports betting industry with DraftKings CEO Jason Robins. But first, we dig into these markets, but the number one name that is dragging down the NASDAQ, it's Amazon. We're off by 3.6%, the worst day for the stock since December the 18th. This is all about the earnings that we get. The fact that they managed to be in line for their fiscal fourth quarter, 10% growth in revenue. We see earnings overall showing 60% more than growth in operating profit, but it's the forward-looking guidance that once again has us a little bit anxious, and it's all about AWS. Let's get to it, Bloomberg Intelligence analyst Poonam Goyal. And first off with AWS, they're committing to yet more spend, $100 billion. That's going to be the run rate that's necessary to capture the extent of demand for cloud right now.
Yeah, you said it absolutely right. So we're not so surprised by that because we heard that from Microsoft and Google earlier too. But $105 billion in 2025 and likely thereafter means they're spending more on AI. But that's a good thing, right? We want to see them spend more because there is going to be higher demand for AWS services, and Amazon needs to make sure that they're investing and not behind the curve.
What did the company say about its e-commerce business? We forget this now in all the talk about artificial intelligence. How is it fending off competition there?
Yeah, e-commerce actually had a very nice quarter on the heels of a very strong holiday season. They did well, surprisingly, in their physical store business, which is also a small piece of the business, but the fact that it grew nearly high single digits was surprising and promising on the efforts there. For the online side, very good growth there, and we are looking to see what happens in 2025 with the added tariffs.
Let's just talk about whether or not commerce can be supporting ultimately the amount of capital expenditure that's going on here, Poonam. It feels as though this is a company that is cash rich. Most analysts have upgraded their price targets on the company today, even though we see those weaknesses in the shares. People are willing to wait, right?
Yeah, people are definitely willing to wait. I mean, there's a lot of profitability that will come out of Amazon over the coming years from the AWS business, but also from advertising, which is a key driver here to profitability with even higher margins than AWS, and retail is a driving force behind that higher advertising momentum.
That's Bloomberg Intelligence analyst Poonam Goyal. Thanks so much. Let's go over to China, where tech stocks have helped power a bull run for their market. Xiaomi among shares surging to a fresh record on the back of new product launches. Let's bring in Bloomberg's Peter Elstrom for more. Peter, what did Xiaomi unveil that got investors so excited?
Yeah, hi, Jackie. Xiaomi is best known for its smartphones, of course, and they've competed with Apple and Huawei in the market quite effectively. But they also have this whole ecosystem of other devices that they're able to tap into. That includes cars now. They went ahead with a car venture while Apple pulled away from that. They also have a lot of wearable devices. So there are a couple of bullish sentiments there. One, there's this overall sentiment that the China market is quite strong right now. On top of that, Xiaomi seems to be growing quite a bit, and the Chinese government is offering subsidies in a number of different areas, including wearables, that could benefit Xiaomi in the long run. So they have this whole ecosystem that is probably going to be able to benefit from some of these growth opportunities.
Looking at Xiaomi Autos, another auto that's been on a tear, BYD, we're all looking at autonomous. We're looking at a key competitive threat here for Tesla that saw Chinese sales fall like they have done around the world.
Right. BYD, of course, surpassed Tesla in terms of the number of electric vehicles sold. They've been a breakout success from China, really, and they've had success beyond the country in a number of different areas. So they didn't even announce anything that gave this the shares this big bump. There's a report that they're going to have an announcement next week, and the anticipation is they're going to talk about their autonomous driving capabilities. They think they're going to take a step forward there, and that really benefited the shares on top of this overall bullish sentiment in China.
There's another boost here that's helping lift Chinese tech stocks, DeepSeek, which is completely the opposite reaction that U.S. tech markets had. Kind of explain that for us, Peter.
Right. DeepSeek, of course, is this AI model that has come out over the past few months, but really a couple weeks ago captured the world's attention because it's an AI model that is competitive with OpenAI's alternative offering, but they did it at just a fraction of the cost. It's unclear exactly whether the costs that they announced are exactly in line, but nevertheless, it was certainly much, much cheaper than what the companies in Silicon Valley are doing. So DeepSeek itself is of course, not publicly traded, but that's given the sense of optimism for the rest of the Chinese market. And you've seen an uplift in a number of different stocks. In particular, Alibaba, best known for its e-commerce business, announced an AI model that's supposed to be quite good. They said theirs is actually better than DeepSeek's. It's not clear whether that's the case, but their stock has been rising quite a bit. Now, this comes against the backdrop that Alibaba got beat up for years by the Chinese government, so they're still far, far off their highs from 2020 and 2021, but they're recovering a fair bit here.
The sentiment, of course, can whipsaw, and a lot of that's to do with just the economy over in China. There's tariffs and concerns about US-China relationship going forward. But for now, does this sort of bullish sentiment feel resilient? Is it all just pegged on the latest AI development, Peter?
It's so hard to tell, really, especially in China, because there's a lot of things that you can't see that are going on beyond the numbers, beyond the specifics that we see. There certainly are analysts who believe that this is going to be sustainable from here. One analyst put out a report called "China is going to eat the world." China will eat the world. You know, very bullish sentiment for some of these China stocks, including Alibaba and Tencent, which had been leaders in the past. But again, the Chinese government had really beat up those companies in the past, so they're just gaining back some of that ground.
Peter, let's talk about trade tensions, because amid all this optimism, what does all of this mean in the long term, or even really in the short term, as some of these tensions escalate with President Trump in Beijing?
Right, Jackie, you're hitting on another one of the very key factors in the unpredictability of the whole sentiment here. You have a number of Chinese companies that will get caught in the crossfire between the U.S. government and the Chinese government if, in fact, they escalate from here. We've already seen the U.S. put these 10% tariffs on Chinese goods. Also, they eliminated this rule, the de minimis rule, that really helped PDD Holdings, the parent company of Temu, the e-commerce player that has been on such a tear, and also Shein. Those companies are certainly going to get hit by some of these changes. It's a matter of whether they're going to continue with those. The Trump administration, of course, has gone back and forth on some of these tariffs. We saw them announce them for Mexico and Canada and then back off of them. So far, the Chinese tariffs are in place. It's probably aren't going to go away, but you can imagine the Trump administration negotiating a bit here. So unpredictability is really going to be the key.
Doesn't it just? Bloomberg's Peter Elstrom, thanks so much. Coming up, we're going to hear from U.S. Treasury Secretary Scott Bessent on Elon Musk's Doge efforts. That exclusive in a minute. But first, we're watching shares of Pinterest too. Earnings abound. Pinterest surging almost 18%. Revenue for the current period expected to be about $837 to $852 million. That exceeded estimates. They also really managed to push across expectations in the holiday quarter for revenue and profitability. From New York and San Francisco, this is Bloomberg Technology. US Treasury Secretary Scott Bessent says a lot of misinformation is floating around Doge, and that he personally vetted the Treasury employees on Elon Musk's government efficiency team with read-only access to federal payment data. He sat down with Bloomberg's Saleha Mohsin yesterday for an exclusive interview. Just take a listen.
These are Treasury employees. It is 2 Treasury employees, one of whom I personally interviewed in his final round. There is no tinkering with the system. They are on read-only. They are looking. They can make no changes. It is an operational program to suggest improvement. So we make 1.3 billion payments a year. And this is 2 employees who are working with a group of long-standing employees.
The letter that the Treasury Department sent earlier this week talked about how the team currently does not have access to change the system. Have they at any point this year had the ability to make changes?
Absolutely not. This is no different than you would have at a private company. And by the way, the ability to change the system sits over at the Federal Reserve. So it doesn't even lie in this building. So they could make suggestions on how to change the system, but we don't even run the system.
And if they ask for, if they request the ability to change the system, would you grant that?
No, again, they have no ability to change the system. I have no ability to grant that change. That they can make suggestions, then it would go to the Federal Reserve, and just like any large ERP system, there would be tests, there would be this, there would be that, and then the Fed will determine whether these changes are robust or not.
As the Secretary of Treasury, you also oversee the IRS. Do you know what kind of access the team has to IRS data or individual taxpayer data?
Well, I'm glad you asked that too, because look, the IRS, the privacy issue is one of the biggest issues. And over the past 4 years, we've seen a lot of leaks out of there. The IRS systems are quite poor. When I started in college in 1980, I learned the program in COBOL. I think there are 12 different systems at the IRS that still run on COBOL, but as of now, there is no engagement at the IRS.
And if they request that access, would you sign off on that request?
They haven't, so we'll take that when it comes to it. I think there is a lot to do there, but the president was elected with a big agenda, and to the extent that getting the IRS in better shape is part of that, sure. Because look, with the IRS, what am I concerned about? I am concerned about collections. I'm concerned about